America's banking industry is shrinking.
Community banks are struggling. We had about 7,000 community banks right after the crisis. Now we've got about 4,000. That's a huge decline.
We see that those local banks are really disappearing. It's really hard for them to compete with the very largest banks who are essentially subsidized by the public because they are seen as too big to fail.
The four largest banks in the U.S., J.P. Morgan Chase, Wells Fargo, Bank of America, and Citigroup, hold an increasingly large percentage of the banking industry's assets.
The general phenomenon that it's easier for the regulators to let a small bank fail than a big one itself gives banks an incentive to consolidate.
The U.S. has nearly 4,500 banks.
That's a big number compared to other countries that are similar to us in terms of economic development, even when you control for population.
For example, in Canada, there are a mere 79 banks. In the midst of the 2008 financial crisis, the World Economic Forum named the Canadian banking system the soundest in the world.
There's never been a banking crisis in Canada. Good for them. Hats off. I think they do a lot of things that are right. I think the regulatory culture is good there.
A concentrated banking system like Canada's may provide more stability, but it could also limit competition and innovation.
If you're a small business in Canada, it's harder to get the kind of lending at scale when you're smaller than it is in the United States, and that potentially means less employment, less innovation, less productivity, less GDP growth.
So, would the U.S. benefit from a consolidated banking system like Canada's?
Canada's banking system is one of the most concentrated banking systems in the G7 countries.
The banks known as the Big Six hold 93% of Canada's deposits.
I think some people certainly would refer to it as an oligopoly.
Larger banks are less likely to fail than small ones because they have a more diversified depositor base.
Because we have always had more conservative lending standards and a sort of a safer system there, in 2008, we had no subprime mortgage crisis, no foreclosure crisis, no housing market collapse. People's retirement savings were preserved.
The risk-taking with the Canadian banks is less than it is in the U.S. The U.S., we have a little different approach. We like to encourage innovation.
Canadian banks may be more conservative in part because of regulation.
We do have one federal regulator. It's the Office of the Superintendent of Financial Institutions. It runs federally across the country, and it does collectively what sort of three different regulators at the federal level would do in the United States.
Among other duties, the OCC, the Federal Reserve System, and the FDIC together regulate banking. The OCC focuses on national banks, federal savings associations, and federal parts of foreign banks. The Federal Reserve System supervises state-chartered banks within its system, savings and loan holding companies, foreign banks operating in the U.S., bank holding companies, and more. The FDIC is the primary federal regulator of state-chartered banks that choose not to join the Federal Reserve System and is the backup supervisor for the remaining insured banks and savings associations.
This kind of regulatory complexity maybe leaves room for some innovation, right? So that if you have a great idea for a new way of doing banking and you can't make it work under the federal OCC chartering system, maybe you start as a state bank and it allows you on a smaller scale to innovate and to create something new, which then you could scale up if you wanted to. On the downside, of course, there are potentially gaps in coverage for people.
There have been 570 bank failures in the U.S. since 2001, including one as recently as June of 2025. Over the same period, Canada has had none. In March of 2023, Silicon Valley Bank experienced the third largest bank failure in U.S. history.
Stocks down and fear up about the fallout from the collapse of Silicon Valley Bank.
When depositors at Silicon Valley Bank got nervous, you know where they headed? They went to the nation's largest banks. And even though their deposits would still be uninsured, they knew that they would always be protected because those banks were too big to fail.
One of the reasons Canadian banks have done well is because a lot of them have operations here in the U.S. where they can take more risk and make more money.
By 2023, half of everything the Big Six banks owned and owed was foreign, offshore, about 80% of it American. They're working in spaces that are far more volatile, far less regulated than what they're doing in Canada. And the truth is that if a Canadian bank failed because of some of these high-risk, high-return bets they're making in other spaces, it would be disastrous for the Canadian economy.
Naturally, the bigger the bank is, the more it will be seen that its failure will create damage to the economy, will create political damage that is just unacceptable. And so this is the too big to fail phenomenon.
Consolidation and the too big to fail phenomenon often go hand in hand.
The regulatory phenomenon, which it historically seems to, has said that big banks are more likely to get bailed out by small banks. This is a moral hazard. It can lead big banks to take excessive risks, and the regulators have to watch for that through the other regulations they impose. But the general phenomenon that it's easier for the regulators to let a small bank fail than a big one itself gives banks an incentive to consolidate.
The Supreme Court really was prescient decades ago in a case known as Philadelphia National Bank. And what the court said was that when banks can consolidate and get bigger and bigger, that can push the rest of the economy to also consolidate. It's one of the reasons we want a very diverse banking system with banks of all sizes.
The American Bankers Association says that the U.S. has one of the most diverse banking systems in the world. Community banks account for 90% of all FDIC-insured institutions in the U.S.
It's long been the case that the U.S. has had an edge because people with a business idea can go to a local bank and get a loan.
Small banks account for a disproportionate share of small business lending. As of 2024, 29% of loan, line of credit, and cash advance small business applicants sought financing at small banks.
Community banks in particular do a very, very large percentage of small business lending. So weakening them, you weaken and restrict a key point of credit availability for our smallest businesses and an engine for economic growth, because small businesses are the lion's share of job creation in the U.S. So that is extremely important. And they provide some competition too.
It could be that small business borrowing is hurt by the move to consolidate, in which case we shouldn't go down to just 3 national banks, even if that would be maybe the safest from a regulatory perspective. I think a lot would be lost for consumers and maybe for small business borrowing as well.
Market domination is never a good thing. You lose competitive pricing, you lose innovation, you lose competitive spirit if you have these huge market concentrations.
Let's take the example of Canada. Canada's banking system is highly consolidated. They have for years lagged the performance of the U.S. economy.
The U.S. economy is roughly 13 times larger than Canada's, whose GDP is comparable to that of New York State.
When you have a concentrated system where 6 players really dominate the market, that allows that industry to be quite controlled by those 6 players. Canadian banks can charge more for service fees, and they do. They can keep competitors out. And there seems to be some evidence that they do that when you consider that there hasn't been a new big bank that has emerged in Canada since we became a country.
The culture, the mindset of the Canadian system is more prescriptive and controlling of banks and their decision making, while we rely more on stronger capital and allow a little bit more risk and innovation, which within parameters is a good thing.
The American banking system has undergone significant consolidation in the last decades. If you go back just to 2005, so just 20 years ago, there were about 7,500 banks. So we've lost 3,000 about in 20 years. And then if you go back to 1975, there were 14,000. So about 3 times the number that we have now.
In 1921, there were over 30,000 commercial banks operating in the U.S. This was the result of state laws that limited the number of branches a bank was allowed to open and made it illegal for banks to operate across state lines.
Now, these rules started to be rolled back, both at the state and then finally at the federal level in 1994. And so, although we already had some consolidation before then, consolidation really kicked off in the mid to late 90s and has been going like gangbusters ever since.
Large banks have gone on a merger spree. Some of the biggest banks we see today, JP Morgan Chase, Wells Fargo, Bank of America, Citigroup, they are really the result of an empire building exercise to gobble up regional and community banks.
In June, the Federal Reserve proposed easing capital requirements, a move that would lower financing costs for megabanks.
If these policies keep up, then I think they're going to get bigger and bigger and bigger, and we're going to see even more consolidation.
Another factor encouraging consolidation is fixed costs, or recurring expenses that don't vary, regardless of demand.
When you have high fixed costs, and fixed costs have increased in banking as there has been more regulation, you can only be profitable by spreading those fixed costs over a larger amount of revenue. Opening up a crypto department will also have a fixed cost associated with it. So a bigger bank will spread that fixed cost over more customers. So I think that as we have new technologies and innovation, including crypto, in the financial area, that will also push us toward consolidation.
But some experts worry that continued consolidation will harm local businesses, stifle innovation, and limit economic growth nationwide.
When small banks disappear, the local businesses that they served struggle to get the attention of loan officers who work at the largest banks. So if we really care about economic growth across the country, we really have to make sure that local banks in our country don't go extinct.
So what is the right number of banks to have in the U.S.?
The right number would change over time, right? We wouldn't expect the right number in any other industry, the right number of firms to be fixed. There will be supply and demand conditions that would suggest, okay, we're going to have an increase. There's startups happening. There'll be proliferation. And then there'll be supply and demand conditions of periods of consolidation and shrinkage, right? So banking should generally, when subject to market conditions, fluctuate like that.
So I think when you ask yourself, is the Canadian concentrated market worth it? It's not as though our choices are just a super decentralized system like the American system or a super concentrated system like Canada's. It's not an either-or choice, right? That we have a concentrated sector that maybe would benefit from being a little bit less concentrated, and we would maybe not lose some of the upsides that we've seen in terms of stability and system sort of crisis response.